Hello students, welcome to Global Online Platform. The students who are going to appear for the UGC NET June 2024 exam from Management or Commerce subject, today's video is going to be very much helpful for you. In this video, we are going to discuss the most expected MCQs on Accounting and Finance. Afterwards, so this is the part 3 of the unit. If you haven't watched the earlier two parts, they are available in the playlist. You can watch the Management Expected MCQ series playlist and check them from them. And after watching this video, you will be able to tackle the questions of Accounting and Finance in your exam. Before starting with the questions, there is an important information for you that the UGC NET exam is very close now. If you take the complete courses on Commerce and Management, you will get daily live lectures, complete syllabus notes will be provided, full syllabus mock test will be provided, 4000 plus MCQ series will be provided to boost up your preparation and MCQ practice, PYQs will be provided for explanation, and the biggest advantage is if you take the paper 2 course, you will get paper 1 totally free. The new batch is going to begin from 20th May, so you can join the batch. The fees is 10,000, but after the 20% discount, you can avail the course in 8,000 only. So to join, download the Global Online app. First, you have to download the Global Online app. After downloading the Global Online app from Google Play Store, click on Store button in the home interface. In the search tab, type UGC NET Paper 2 Management. Then search the Paper 2 Management. Then make the required payment. After making the required payment, you can access all the content of paper 2 and paper 1. If you face any difficulty, you can contact on the given number mentioned on the screen. Now, first of all, the first question is the corporate dividend model is given by dash John Linter, James E. Walter, William Denning and Ezra Solomon. So first we have to do what? First we have to see who has given which model. Corporate dividend model is also known as Lintner model. Okay, Lintner, I told you the name, so obviously it is given by John Linter. Okay, James E. Walter has given the share valuation and Walter model. Then William Denning, he is totally out of question because he has no role in the financial management. Ezra Solomon has contributed in the capital structure approaches or theories, you can say, and residual approach to dividend he has also given. Okay, so this model of dividend is also given, the corporate dividend model is given by John Lintner. This model has focused on two different things. That first is the target payout ratio, and another target payout ratio means whatever you dividend want to pay to dividend in the long term perspective, in the long term period, whatever, by which rate. Suppose this is 10%, by 10% I want to give to my shareholders a dividend till next 5 years. So I will do. Now if I want to increase this 10% to 15%, what will be my speed of converting this 10% into 15% rate of dividend? It is indirectly concerned with the earnings. Okay, so option number A, John Lintner, will be right answer. Next question, according to the dividend irrelevance theory proposed by Modiglani and Miller, what is the impact of the dividend policy on a company's valuation? Option A, dividend policy significantly impact on the company's valuation. Then dividend policy has no effect on the company's valuation. Dividend policy only affects the company's short-term valuation. Dividend policy is the most important factor on determining the company's valuation. So basically in case of dividend we have two types of theories. One is the relevancy theories and another is the irrelevancy theory. Relevancy theory consists of the Walter and Gordon model, and irrelevancy theory consists of the Modiglani and Miller. And another one, another model which is concerned with the dividend is the Graham and Dodd model. Okay, let it be. So basically the most important factor, dividend irrelevancy means what? Whether you are paying dividend or not dividend will not have any impact on the value of the firm. So okay, this has been said by the Modiglani and Miller theory. Okay, then most important factor, you can delete it. Affect the company's short term valuation, this you can also delete it. And significant impact on the company's valuation, this you can also remove. The right answer will be option number B, dividend policy has no impact on the company's valuation. Then what will impact the value of the firm? Company valuation will be affected by the investment policy, not the dividend policy. Okay, so option number B, dividend policy has no effect on the company's valuation, will be the right answer. Let's move to question number third. Which of the following is a limitation of the Gordon growth model? It can only be applied to the companies that do not pay dividend, then it does not take into account the risk of investment, then it assumes the growth rate is higher than the cost of equity, and it assumes that the the dividends grow at a constant rate forever. Then try to understand this question. It is asking about the limitations of Gordon model. Okay, so first of all, wherever it has mentioned only, it can be only applied to companies that do not pay dividend. It is not paying dividend, then how you can apply the Gordon growth model there? So it is not possible. No? It does not take into account the risk of the investment, so this is not considered. Risk is considered. Okay, now third one is it assumes that the growth rate is higher than the cost of equity. This is not a limitation. Now if you check the last option, it assumes that dividend grow at a constant rate forever. Due to this the biggest limitation of the Gordon model is it assumes that the dividend grow at a constant rate forever. This is only the major limitation of the Gordon growth model. So option number D will be the right answer. Let's see the next question. According to Walter model, if the internal rate of return R is greater than the cost of equity K, the firm should. Yesterday I had told you the major conditions regarding this, so hope you will do it correctly. So pay out all the earnings as dividend, retain all the earnings for reinvestment, follow a residual dividend policy, or borrow more funds to pay dividend. Okay, so this will no borrowing will be done, no residual policy will be followed. Either now it is saying what R is greater than K. Okay, returns are greater than cost of equity. So in this case we will retain the retain the earnings for reinvestment purpose. Okay, we will retain the earnings for the reinvestment purpose. So option number B will be the right answer. If it has asked R is less than K, R is less than, at that time the company will pay out all the earnings as a dividend. So option number B, retain all earnings for reinvestment, is the right answer. Let's move to next question. Which of the following argues that the value of the levered firm is higher than that of the unlevered firm? Net income approach, net operating income approach, then model with taxes, and both A and C. Now if you say what it is asking, then what it is asking, okay, sorry, there was some this one error in this question. The option number C is the Gordon model. Okay, option C is Gordon approach. So if you see that which it is asking about the levered firm. Levered firm means what? The company who has taken debt or who is using debt. So it is also called as a levered firm. It can be as it will be higher. The value of the levered firm means the company who is who is using debt will have a greater value as compared to the company who is not using debt. So this is basically said in the net income approach. Okay, net income approach says what? Net income says that whenever you grow the value of the firm, whenever the use greater amount of debt in your capital structure, the value of firm will rise and the overall cost of capital start reducing. Okay, so option number A, net income approach, will be the right answer. Next question. The cost of equity share capital is greater than the cost of debt because equity share carry higher risk than debt. The face value of equity shares is lower than the face value of debentures in the most cases. Then equity share do not provide a fixed dividend rate, and equity shares are not easily sellable. Now let's see what is the reason behind that the equity cost that the cost of equity is greater than the cost of debt. Now first of all, try to eliminate one by one. Equity shares are not easily sellable. This is not an appropriate answer because sometimes people want to be owner of the company. They purchase equity shares so that they should get voting rights. So these are sellable. So this option does not exist. Equity share does not provide a need of dividend fixed dividend rate. This is true, but but it is not, it doesn't mean that equity share cost of equity should be high. So this is also inappropriate. Then the face value of equity share is lower than the face value of debentures. So this option is also incorrect. The right option is equity shares carry a higher risk than debt. That's the only reason that the cost of equity is high. If you haven't studied the NOI, means the net operating income, it states that after raising the amount of debt or raising of debt into after beyond a certain proportion, the cost of equity starts rising because the equity shareholders feel it more risky. That's the reason that equity share is involves the cost of equity is greater than the cost of debt. Option number A, equity shares carry a higher risk than debt, is the right answer. Next question, Gordon model of dividend relevance is same as no growth model of equity valuation, constant growth model of equity valuation, price earning ratio and inverse of price earning ratio. So price earning ratio, it is not the Gordon model is, Gordon has given in the computation of cost of equity, Gordon has given a DP plus growth model, dividend price plus growth model he has given. So the Gordon model of dividend is relevance in same as the option number B is correct answer, that is constant growth model of equity valuation. Option number B will be the right answer. Next, see, the term capital structure denotes total of liability side of the balance sheet, equity funds, preference capital and long term debt, then total shareholders equity and types of capital issued by the company. Types of capital, company can issue both the types short term and long term. So basically what the types of capital the company is issuing does not matter here. Then types of shareholder total shareholder equity, this also is not applicable in this question. Capital structure it is talking about. So capital structure, long term sources of finances will only be considered. Then liability side of balance sheet, in case of liability side there are both current as well as fixed long term as well as short term liability. Short term liability will not be considered. So the most accurate answer here is equity funds, preference capital and long term debt. Okay, this play a major role in the computation of capital structure of the company. Now let's move to the next question. Here you have a numerical practical based question. Cameron Industries is expected to pay an annual dividend of rupees 1.30 a share next month, and the market price of the stock is 24.80 and the growth rate is 3%. What is the firm's cost of equity? So it has asked to compute the cost of equity. So to compute the cost of equity, here what are the things given to you? One is the growth rate, another is the market price of stock, and the most important thing is 1.30, that is the expected dividend. Okay, so 1.30 upon the 24 by 0.80 we will write here, and plus the 3%, whatever the 3% is mentioned here, you should mention it 0.03. okay, after solving the this is the formula for computation is d1 upon p0 plus g. okay, this is the formula of the growth model. Now after solving this numerical, you will get the answer, that is the 8.24%. okay, after solving this numerical, you will get the answer 8.24%. okay, for if you want me to solve this, after solving this numerical first portion, when you will solve the first question, you will get the answer, that is the 0.0524. Then you have to add 0.03 in it, and then you will get 0.0824. When you will multiply it by 100, you will get the answer 8.24. 1 second. You will get the answer 8.24%. So option number C will be the right answer. Okay, option number it is not mentioned here. Option C will be the right answer, 8.24%. Next question, the selection of the one proposal based on the choice of other proposal is called Contingent investment proposal? No. Replacement proposal means suppose you have project A and you have project B also. So you have to select selection of project A. Will you replace by B? No. So this is selection of A will not be replaced by B. So replacement proposal also an incorrect option. Independent investment proposal means selection of one has no impact on the another. So this will also not be not correct. The right answer here, the most accurate one, is the mutually exclusive proposal. And which method of capital budgeting is most appropriate for the mutually exclusive projects is the NPV, that is the net present value method is most accurate. Okay, mutually exclusive projects is what? Mutually exclusive means what? One, if you suppose A and B are two projects and you want to select A by application of proper capital budgeting techniques, you decided to select the project A. When you will select A, the project B will automatically get rejected. Okay, this is the concept behind the mutually exclusive project. Okay, so option number D is the right answer. Mutually exclusive proposal is the right answer. Suppose, for example, I will let me give you another example. Suppose you want to marry and you are looking for various brides. Whenever and you got 2-3 proposals. One of them you have selected, another two are automatically rejected. Okay, so let's this was just a joke, ignore it. The DCF technique of capital budgeting does not include the following. Now DCF is what? DCF is the discounting factor technique. Okay, net present value, PI profitability index, IRR internal rate of return, and ARR average rate of return. Okay, NPV method, this is discounted. Then PI method, this is also discounted. Present value factor is used in this case. In case of internal rate of return, here also present value factor is utilized. But in case of ARR method is the technique which is traditional in nature, and here it does not consider time value of money. So DCF is not used in it. So, okay, so option number D, ARR average rate of return, will be the right answer. Next concept, here also we have a practical on cost of capital. A company issued limited rupees 100 lakh 14% debenture of rupees 100 each. Tax rate is 40%. You have to calculate the cost of debt with a 10% premium and 5% of flotation cost. So this is cost of debt, you should know. Generally there is a chance NTA can ask you questions from the cost of capital. Numerical based question will be asked. So first of all, try to understand the formula. Cost of debt is equal to interest upon net proceed 1 minus tax rate into 100. Okay, now let's see, now put the values. The 14% debenture is what? It is the interest rate. Okay, 14% is debenture is what? It is the interest rate. Then we what else we have given? 40% tax. 40% this will be written as 0.4. Okay, now you will ask, sir, ki what to do with the net proceed? From where we will bring the net proceed? Don't worry. I will tell you how you can bring the net proceed. First of all, you have given what? You have given the 100 as a face value, and what it has said that the company is issuing the share at the premium. The debt is issued at 10% premium. So first of all, you have to add the 10 and 5% flotation cost. You will subtract the 5% 5. So this 105, whatever you get after doing this, after solving this equation. So this 105 is what? This 105 is your net proceed. So whenever you solve this, after solving this, you get 0.14 into 0.6 by 105 into 100. So the right answer which you will get is that is 8%. 8% is not not mentioned here, but an approximate answer, that is 8.03 is mentioned here. So your option A will be right, that is option number A, 8.03%. Okay, so I hope you have got the question. If you haven't got, you can take the screenshot of this slide. Everything is mentioned here properly. Now let's see the another one. Ram Limited Company issued the rupees 100 lakh 12% debenture of 100 each. Tax rate is 50%. calculate the cost of debt with 5% discount and 3% flotation cost. Now in while compute now everything will be same, but let me help you to solve it. First of all, interest upon net proceed 1 minus tax multiplied by 100. Okay, so let's put the values. Means here the interest is 12%, then whatever what else we have given, the tax rate 0.5 we will write here. Then after mentioning here, after solving it, we will get 50 net proceed. Net proceed we are yet to compute. Okay, just a second. Okay, KD interest upon net proceed 1 minus tax multiplied by 100. दिखेगा नहीं इनको. Let me write here. Interest upon net proceed 1 minus tax multiplied by 100. This is the formula. Now start putting the values whatever is available. So 12 is available, then 1 minus 0.5 is available, and into 100 is available. We are yet to compute the NP. Now in case of premium, whenever the debentures are issued at premium, first of all you should add the value. Whenever the debenture is issued at discount, you should reduce the value. If the dividend are issued at par, you don't need to do anything, keep it as it is. So the face value of the dividend is 100, the rate of discount is what, 5, and the flotation cost is 3. Okay, so you will get, after reducing 8 from 100, you will get 92. This 92 is what? This 92 is your net proceeds. Okay, this 92 is what? Net proceeds. After solving this equation, you will get the answers 6.52%. Okay, 6.52% is the right answer. I am not providing the calculation because I know that you are well enough in it. Okay, mastery, you have well mastery in it, so I have shown just how to calculate the net proceed and how you can put the do the calculation. So option number C will be the right answer. This question has, the solution has been provided here also, you can solve it. Now let's see, a company has a preferred stock pays the annual dividend of rupees 6 and is currently priced at rupees 50. What is the cost of preference stock? 8%, 9%, 10%, 11%. So basically it has said that preference stock annual dividend of 5 is being paid and the currently 5 at 50. Okay, this is what the preference KP is not, this is not Kadi Pakoda, this is D1 upon P0. P0 it is the expected rate of dividend and this is the current price. So this is 5 by 50, this will be nothing but 1 by 10, but it is the simplest is 10%. Okay, option number C, 10% will be the right answer. Next, let's see the next question. A firm's common stock is currently, common stock means what? It is talking about nothing but the equity share. Okay, now equity share, it is selling about the 40 per share. Okay, currently selling price is what? Same formula you have to use, but here it is mentioned what? Constant growth rate at 5%. Constant growth rate. So immediate, no need to worry. You have to put the formula, that is D1 by P0 plus G. Okay, now let what we have to do, first we have to check the values, where are they. So selling for 40 rupees. Okay, then 2 by 40 and then the expected dividend is 2 and the growth rate is what? Growth rate is 5%. So you add 0.05 here. So by solving this numerical, you will get the value 10%. Okay, you will get the value. This will be 1 by 20 and 5% plus 5%, you will get 10% here as an answer. Okay, this will be your answer, but 10% is not mentioned accurately, so you should not worry what to do, sir. So this 10.2 will be your answer. Okay, option number B, 10.2% will be your right answer. Okay, so this numerical has been solved for your convenience, you can check it. So that's all for today's session. I hope you enjoyed the session. So thank you, bye, good night. I hope you enjoyed the session. If you like the session, just hit the like button. Your one like motivates us. Let's see you in next video. Thank you, bye, good night.